Afternoon, good evening. This is Ed FX Trader. I'm here to do another video lesson and to provide an update on my trading performance. Now, what I want to do, last time I recorded a video. It was about spatial intelligence, and certainly you need to review that video over and over and over and over. Now, having learned about spatial intelligence, what I want to do now is to talk to you about the 5 steps to trading. Right, our 5 steps that we want to use whenever we're going to trade. I'm going to get right into it because there's a few things I want to do the lesson, do due diligence to it, and then I want to show you how to apply it in the actual trading. So we're going to also look at a chart and we're going to apply these 5 steps. Now, when it comes on to trading, there are 5 steps that you must consider whenever you're going to trade, right? It is important that you consider these steps before you trade. These steps should not be excluded whenever you're going to trade. So the 5 steps are equity management, direction, stop, entry, and limit. I'm going to explain each of these in detail. The most important one here being equity management. So we're going to go straight into that. Now, when we talk about equity management, we're talking about how you're going to manage your capital. You decided that you are investing X amount of dollars, and whenever you place a trade, there is a potential that the trade will not go in your favor. So when it comes on to equity management, we have to talk about risk and risk management. What percentage of your capital are you willing to risk whenever you trade? How you're going to manage your loss whenever you're going to trade? How are you going to trade in terms of your risk to reward ratio? So all of those things must be considered, because remember, you're dealing with money here. Generally in trading, we want to keep our losses small and our winners big. So cut your losses small, as it is said in trading, and let your winners run. So risk management. We talk about here the percentage of your account that you're willing to risk. Now, everyone's risk tolerance is different. So you predetermine how much you are going to risk, how much you can afford to risk without you losing a headache over it, without you having to check your charts every 10 minutes. You can place a trade, walk away, and you know if it doesn't work out in your favor, you're only going to lose X amount of dollars, because you have to deal with the psychological and emotional aspect of trading. Trading is really just about 10% technical. Most of it is psychological. Most of it is emotional. So you have to learn how to deal with that, because we're dealing with money here. So what percentage of your account that you are willing to risk, right? So you need to determine that. Generally, we want to trade with a 1 to 3 risk to reward ratio. So for every dollar we risk, we want to try and make $3. If you can do that mathematically, you will see how it works out in your favor, and I'm going to give you an example later in this presentation. As a rule of thumb, do not risk more than 2% of your trading account on a single trade. Whenever you decide that you are going to trade, do not risk more than 2%. In some cases, 1%. In some cases, 0.5%. It depends on the account size, because 2% on $1,000 is different from 2% on $100,000. You might not want to risk 2% if you have a $100,000 account. So it will vary depending on the account size. But generally, as a rule of thumb, you do not risk more than 2%. If you risk more than 2%, it's considered that you're over trading your account. You must predetermine how much you are willing to risk and how many trades you will take, right? Because if you risk 2% on one trade and you're going to take 3 trades and you're going to risk 2% on each trade, you're going to end up risking 6% across 3 trades. right? And that's considered over trading your account. If you lose on all three trades, you would have lost 6% on your account. So when we say, okay, do not risk more than 2% of your account, you also have to determine, well, how many trades am I going to take? So what is going to be my max risk? My max risk. If I'm going to trade I'm going to take 3 trades, right? Do I want to risk 2% across for each trade? You can say, okay, I'm going to risk 2% overall considering these 3 trades. And so you do the mathematics behind that and you just risk that across the 3 trades. So that will require you lowering your lot size. And I'm going to show you how to do this. We have calculators to help us do all of this. So I'm going to show you how to do it practically. And do not overtrade your account. Do not take 6 trades, 10 trades, and you're risking 2% on each trade. You know, you're taking 10 trades and risking 2% on each. That's a 20% exposure. Now, you might really not lose all 10 trades. That's the truth. But anything is possible in this market, and you cannot get overconfident in this market. And you know, this is a lesson for me as well, because I have been trading a particular way, and I knew it's not the best way of trading, and so I finally come to the point that I've decided I'm going to have to adjust the way I trade, and I'll show you why later in this. Now, outside of equity management, so equity management is the number one thing. Next thing you must consider is your direction. Outside of equity management, direction is the most important thing, right? Now, direction just simply speak whether they believe that the market is going to go up or the market is going to go down. The market can only go up or down. So it's either you're going to be a buyer or you're going to be bullish, or you're going to be a seller, you're going to be bearish. So it's either you're going to buy or sell the market. Now, how you determine the direction is through your analysis. I am primarily a technical trader, so I primarily do technical analysis, and I keep up with what is happening fundamentally, right? So whenever I show you the chart and I do my analysis, that's technical analysis, but we must know what is happening fundamentally, especially right now with Great Britain and the whole issue of the Brexit. They voted in 2016 to leave the European Union, and the pounds fell drastically. Now they're supposed to solidify a deal by next year March, when they officially leave the European Union, and Theresa May, the Prime Minister, is having a hard time signing off on a Brexit deal. She has recently on Sunday got one approved, but now it needs to be taken to Parliament and they need to vote on it. So there's a lot that is happening with the pounds right now, the Great British Pound. So I mean, it's not looking too nice. So if anything, you definitely probably want to be looking to sell the pounds. I don't trade it any at all, because you're going to have some big movements, especially on December 11th, when Parliament is going to vote on the deal that has been struck, whether it is going to pass or not. So you want to consider direction, right? Whether you're going to buy or sell. After you have direction, you must then decide where your stop is going to be. Now, your stop is where you will exit the trade for a loss. You predetermine, okay, I'm willing to lose X amount of dollars. I'm willing to risk this percent of my capital, and so therefore my stop is going to be at this level. And it must be in keeping with your equity management. It must be in keeping, whenever you decide where you're going to put your stop, it must be in keeping with you deciding that you're only going to risk X percent of your account. Now, like I said, there's calculators to help us to do this. Now, you determine where your stop will be before you take the trade. This is planning your trade before you execute the trade. You have to look at the trade opportunity. You have to plan it, considering your equity management, your direction, and your stop. and we never trade without a protective stop order. You must have a stop in your trade to say, if it goes against me, I am willing to lose this. I don't want to trade without a protective stop, because that means that the market can be running against me, and I can either have a margin call or blow my account. All right, so that's your stop. Then your entry. Now, if you have your direction, okay, then you need to determine where and when I'm going to enter the market. Okay, now if your direction is that you're going to buy, now you want to buy, now this is universal, right? And you must consider this all the time. If your direction is up, right, if you're going to be a buyer, you're going to buy, you're going to be bullish, whenever you trade, okay, and universally, whenever you're going to buy, do you want to buy high or do you want to buy low? Right? And as simple as that may sound, it's something that must always be considered. And of course, the answer is that you want to buy low. Whenever you're going to buy, you buy low, and you want to buy in the buy zone. So if you're going to buy, there are two rules: buy low in the buy zone, and do not buy future resistance. All right? Now, I know you don't know some of these things, but just bear with me for now. And if you're going to sell, you want to sell high in the sell zone, right? And we do not sell future support. Okay, I'm going to show you this on an actual trade. Then your limit, and your limit is where you will exit the trade for a profit. All right, and as mentioned in the equity management section, your limit, you want to risk $1 to make $3. So your limit should be at least 3 times your risk, right? If the trade will give you that opportunity, you can do 1 to 2, but if you can do 1 to 3, that would be really, really good. Now, this is why. Risk versus reward. When you trade with a 1 to 3 risk versus reward ratio, you can be a 30% winner and a 70% loser and still make money. Now, if I say to somebody I lose 70% of my trade and I only win 30%, they would probably think that I'm whack. But as you're going to see in this example, you can be a 30% winner, 70% loser, and still make money. So percentages really don't mean anything. Example, you trade and you take 3 trades and you win 3, but your 3 trades are for 150 pips. Okay, so the number of wins, you win 3 times, you take 10 trades, sorry, and you win 3 out of the 10. But the 3 times that you win out of the 10, you're winning 150 pips, right? Each time you win. So 3 wins, 150 pips each, you'd have made 450 pips. 7 losses at 50 pips each is 350 pips. You'll be net profit of 100 pips. So what that means is that whenever you place a trade, you are risking 50 pips. So if you lose 7 times, you're losing 50 pips each time. Whenever you place a trade though, you are aiming or you're winning 150 pips, because your win is 3 times your loss. You win 3 times of 150 pips each, you'd have made $450. You'd have lost 350 pips, and you'd have made 450 pips. So you are net profitable. You would have made 150 pips. That is the power of risking $1 to make $3, risking 1 pip to make 3 pips. And if you can diligently trade like that, now it's much more easier said than done. But if you can have the discipline to trade like that, you'll be profitable in the long run, much more profitable. So what that would mean is that you are not going to take a trade if it doesn't meet your risk to reward ratio. You're just not going to take the trade. All right, now we're going to go into an example. I'm going to take you into an example here. We're going to keep these 5 things in mind as we look at this example. All right, so quickly, right before us now we have the Australian dollar versus the New Zealand dollar. And so I'm going to ask you, what do you see? This requires spatial intelligence. Just what do you see? Looking at this chart, what do you see? Right? I'm going to give you, can pause the video here, see if you can figure out the pattern and then press play. Right? Now when you look at this, there are two things that I see. Okay, I'm going to bring in some trend lines here and some horizontal lines. On one hand, I see if I put this here, this green line here, like to use blue. Let's say I use blue. And if I put another line here, I can see that the market generally moves in between these two blue lines. Right? So that's one thing. Right? Another thing, that's one approach, and you can trade this because you always trade what you see. Another thing that I see here, right, if I remove these lines, alright, and another thing that you might see, I'm going to show this to you right here, which is what I'm using. If I use a line here, and if I draw a line up here, and if I draw a line from here, this is my uptrend line. Okay. Now, when it comes onto channels, as I said to you before, it's not an exact science. But if we use this here, I'm going to use it here, I'm going to extend this. It's not an exact science, but there is also this channel here. Now, the most important thing right now, even if the top is not exactly right, we cannot, without, it is very clear that whenever the market touches the bottom or comes near to the bottom of this line, it goes up. And that has been around from 2016. 2016 it came down here. September of 2016 it went up. It came here in January of 2017, it went up. It came here in June of 2017, it went up. And it came here in April of this year and it went up. Now we are at November, December, and we're at the same point. Right? So I analyze this market and I say, okay, well, my direction is up. Okay. Now I already fully am convinced that I want to buy this market. So we have our direction. Now, like I say, your equity management is up to you. Right? But I'm going to give you an example. We have our direction. We have determined that we're going to buy this market. We have determined it through technical analysis. Now, after direction, I'm going to consider my stop. Now, I know that I want to buy. Where is my stop going to be? Now, I'm going to bring this down to a lower time frame. Let's just carry it down to a daily. Okay? This is the daily time frame. Okay. Now, we already determined that we're going to buy this market. Alright? Now, where would you want to put your stop outside of the wave movement of the market? Now, if I am going to buy, okay, I want you to look at this carefully. If I am going to buy, right, I want to put this market could still potentially touch this line again, even though it has touched it right here. So I want to put my stop, and I'm going to put this in red. I would like to put my stop below the low of this candle. Now this candle, the low of this candle, if you look over here to the far left, you'll see the low. The low of this candle here is 1.0586. So I want to go lower than that. So let's say I am going to go 10 pips lower than that. So that will be 1.0576. So 1.0576 is going to be 1.0576 is where I'm going to put my stop. Okay, that is where my stop is going to be. So that is my stop. We're not entering the trade as yet. We're just planning the trade. So that's my stop. Now I am going to buy, and if I'm going to buy, I want to buy low in the buy zone. Now the market is made up of zones, and I'm going to just quickly show you. I'll do more in-depth videos on this. The market has been going down. As you can see, it has been going down. So the market currently is in a sell zone, right? Over this side is a sell zone, and over this side is a buy zone, and the market has been going down. I determined that I want to buy the market, and I am saying I will not buy this market until the market is in the buy zone. Right? Now, let's see if the market is in the buy zone. I want to trade on the 4-hour time frame. This is what I'm on now. Let's see where the market is. I'm going to draw from this line. That's my outer trend line. Okay, and I'm going to use this. Right? I want the market. The market, whenever it is over here, it has been going down. So over here is the sell zone. Sell zone. And over here is your buy zone. We want to buy the market when the market breaks this trend line and enters into the buy zone. So I want the market to break into this zone. I want the market to break into this zone. I want the market to break into this zone, enters the buy zone. I want it to pull back because I want to buy low, give me a low price in the buy zone because I want to buy low in the buy zone. So I want this market to enter the buy zone, pull back, and then when it pulls back and I see it gives me a candlestick formation or a counter trend line break here, I will buy the market. So it must enter the buy zone, pull back, and then gives me a counter trend line break, and I will buy the market. Now, hypothetically speaking, if the market enters into the buy zone, pulls back, and push up and gives me a trade, right? Let's say the market gives me a trade in the buy zone, and let's say I enter the market here. I'm going to use, let's say the market, I enter the market here. I'm going to pull back here because it gives me a low price in the buy zone, and let's say I enter the market right here. This price point is 1.0670. Let's say I enter the market here. I need to put that in purple. What that would mean is that this is where I enter the market. This is where I'm planning to enter the market. And my stop, this is hypothetically speaking, my stop is 1.0576. How many pips am I risking? How many pips would that be for my entry? So it's 10670 minus 10576. That is 94 pips. So I know that my loss will be I'm risking 94 pips. If I'm risking 94 pips, I want to go for 3 times that. 3 times 94 is 282. So I'm going to add 282 plus 10670 670, and my reward should be 10952. I'm going to put that in green. 1.0952. Okay, so I am risking just about, what was this, 94, was it? I think it was 94. I'm risking just about 94 pips thereabout to go for 282 pips. So that's a 1 to 3 risk to reward ratio. So I'm going to hold the trade until it either hits my stop or goes to my limit. So that's what we consider. So that is my entry. My limit, as I may mention, is 3 times the risk. So that is why my limit is all the way up here. And this becomes your trade plan. Allow the market to enter the buy zone, let it pull back, and then you buy towards there. Right? Now, because we already analyzed the market, right? Let me just open a different chart here. Because we already analyzed the market, okay, we said that our stop is 1.0952. Now, if you look at this, I want to show it to you on a higher time frame. 1.0952 will be about here. And that is very good, because if you look carefully here, this is an area of resistance. The market has been trying to break this here, but has not been able to go higher. Let me see if I can see it a little better on the daily time frame. Right? Here is 1.09. You see this area here? You see that the market since September, every time the market comes to this point here, it goes down. That's because this is an area of resistance. So you don't want to try and trade or take profit beyond this point, because the market has a resistance here. Okay, this is what we partially call do not buy future resistance. If it would be a bad idea if you saw this trade and you decided to actually buy here at this green line, right? So let's say the market comes all the way up here to the green line, and then that's when you decide to buy. You're buying resistance, because past support that pushed the market up, right here, that pushed the market up, has become resistance that keeps on pushing the market down, and you don't want to buy resistance, future resistance, and that becomes your trading plan. Okay, so that is how you plan your trade and you trade your plan. Now quickly on my performance, I experienced my first losing month in October. I lost 2.66% of my account. And November, it seems today's the last day of November, I'm going to also have another losing month. Now, do I like losing? Nope. Not when you have gone 12 months without losing, then your first experience losing. But I'm not concerned, I'm not worried. If you cannot afford losing money in this market, this is not for you, because you're going to have losses in this market. But overall, this year I've already doubled my accounts. I'm fine. And I said that there's a flaw in my trading. There was a flaw that I was always conscious of, and I decided to address it. That is why I've had such high win percent ratio. Because what I was doing was that I was not managing my risk. See here, I was not managing my risk properly. Because I was trading, I just never liked taking a loss, because You know, so as I concerned, I know where this market is going to go, and you know, I get cocky and stuff like that. So I would allow the market to go against me. Now, I was like, no, I'm not going to do this anymore, because I had the market went against me 40% of my trading account. Now, just imagine you have $1,000 and the market goes against you by 40%, $400. Right? And I was like, nope, I really need to take into consideration my equity management some more. And so I've decided that I'm going to do that. Now, and so that's where that is at. I'm not worried. I'm expecting some great movements on the US. This is only going to start going back up. You understand? But I'm making the adjustments. So what I'm doing is that as soon as the market goes against me, I'm just taking the loss. And I'm going to wait to re-enter the market. Because I have the direction, but my entry, I have to fine-tune my entry. Because trading is something that you constantly improve on your strategy until you really are settling how you're going to trade, and that takes time. And so I decided, no, instead of allowing the market to go against me and then wait for it to turn around, I'm just going to let it stop me out and then get in a better entry. That just works out much better. So considering this trade, that we are going to make this trade. Now, I told you that there are calculators to help you, and then I'm going to close off with this. Now, here we are. Now, this is a position size calculator. Now, let's say you have $5,000 in your trading account. Okay? You said that I'm only going to risk 1% on this trade. So let's consider the Australian New Zealand dollar trade that we just looked at. We already know that the risk was 94 pips. Alright? Alright, hypothetically speaking. Let's say your risk is 94 pips. You're only going to risk 1% on your account. Right? So you put in your account balance here. Let's say it is $5,000. You're only going to risk 1% of your trading account. We already just calculated that our stop loss is about 94 pips. And the currency that we're trading is Australian versus New Zealand dollar. When I press calculate here, what this calculator is going to tell me is the trade size right here. The size trade that I should trade to ensure that I'm only risking 1% of my account, with the stop loss being 90 pips, 94 pips. So what I will do is that if this trade plays out, if this word were to play out how we determined it, what I will do is that when I go to place the order, I know, because the calculator calculated for me, that my position size is 0.08. So when I go to place the trade, here where it says volume, I'm going to put in 0.08. In my stop loss, we calculated it. We said 1.0576. My take profit would be 1.0952. And that will be the trade. When it presents itself, I press the buy button and I walk away. If I lose, I'm only losing 1% of my account. And it also tells you what the 1% of your account is. If I lose, I would only lose $50. That's what I would lose. Right? And if I make 3 times the 50, and then I will make $150. But it tells me what size I need to trade in order to keep my risk at 1%, right, with a 94 pip stop loss, and my risk is only $50. Can you stomach losing $50 from $5,000? Right? If you can't, you lower your risk. You can put it at 0.5%, and it will recalculate what you need to trade. Right? So that's it. I know that this video was long. Just continue to follow and stuff like that. As I said, I don't hide anything. I'm transparent. When I win, I win. When I lose, I lose. But I am comfortable. I have to adjust my trading, my risk management, or how I'm trading. I'm taking that hard decision now. Because it's like going through life, knowing that there's a problem that exists, knowing that there's a struggle, knowing that you're not doing something the way you should do it. You acknowledge it and you decide to do nothing about it. And you live 10, 20, 30 years of your life not addressing it. And this is almost 4 years of trading, and I'm going to address this and stuff like that. So my losses are going to be more, but from long as I am winning, because like I said, percentages don't mean anything. For long as I'm winning more than I'm losing, I am fine. All right. And so this is EdFX Trader signing out. And remember, it is God who has given you the power to make wealth. God bless you. Bye.